Hello students and welcome to Legacy IAS Academy. In this session we are going to discuss about the free fall of the rupee against the dollars. So we'll understand why this question is even in the news and why it is highly unlikely that anything like that is going to happen. So let's get started with respect to what the news is. So understand it is not just a one day thing, it has been happening over a period of months. So let us understand what has led to this question. So India's foreign exchange reserves were doing well at around $650 billion and then it increased also further. In fact, it increased up to close to $705 billion. Alright. So we reached an all-time high of $705 billion, which is a very great situation to be in. But then what happened? Then the surplus with the Reserve Bank of India plummeted. It plummeted back to around $650 billion. So it is a plummetion of around $50 billion of downfall we saw. Okay, $50 billion of downfall. Now what, since there was a downfall in the surplus, it started worrying us as to why this is happening and is it going to lead to further let's say not depreciation or further erosion of the surplus with the RBI. And if it is going to lead to further reduction in the value of the rupee or not, is the rupee now going to have a free fall against the dollar? Free fall against the dollar means, let's say $1 is equals to 50 rupees and then in a short period of time this $1 becomes 70 or 80. What is happening? It's a free fall. The value of the rupees is going down against the dollar. Is this what going to happen in the future? In the coming future is what the question was. So we'll analyze that. And let's get started with the analysis. So this was the situation, but now what has happened is there has been an increase, a surplus accumulation of $1.51 billion per week is now happening. So it is sort of back on track and we have from this situation now we are improving. Now presently as we speak we have around $658 billion and we may soon reach this number again. Hope, that is what the hope and also the prediction is. Okay, so I hope this is clear. Now let us understand why this situation happened. Why did the surplus decline from 705 to back to 650? Let's understand that. First things first, the main reason was the pulling out of dollars from the Indian market by the foreign portfolio investors. So the foreign portfolio investors, they pull out money from India's financial market. India's financial market of course is made up of the equity market and the debt market. What is the equity market? A market where you invest in equity. Equity means you get the share. If let's say you are holding 10% of share of a company, that means basically you own 10% of that particular company. Now whatever the profits are there, you will be a part of it. Whatever the loss is there, you will be a part of it. That is what the equity market is all about. As far as debt market is concerned, it is simply like a loan. You take a loan of let's say $1 million at 10% interest rate. No matter whatever you are doing with it, you have to return back $1.1 million. For example, if it was a loan of 1 year, $1.1 million is what you will have to return. Now you can make profits of 100% also, doesn't matter, only this much you have to return. That is the debt market. So this is one of the reason. The other reason was these outflows, like it leads to a domino impact, domino effect. Okay, so when these outflows was happening, outflows means the dollar was leaving the country. The dollar was leaving the country. That means less amount of dollar was present. When less amount of dollar was present, it was putting pressure on the rupee. It was putting pressure on the rupee. Means what? If $1 was 83.5 rupees, putting pressure on the rupee means the value of the rupees is going down. So $1 will now become let's say 84.5 rupees. Means the value of rupees has gone down. This is what was happening. Now if this is what happens, what will happen is it is going to put pressure on rupee. So now RBI would want it to go back to this level. Why? That is the reason behind this is if the value of rupees goes down and let's say if $1 finally becomes 100 rupees, so what will happen? Our imports will become costly. Right, but you will say then sir, if imports will become costly, we will buy less of foreign products. I understand that maybe we as consumers buy less iPhones or less of some other luxury or other products. But what about the compulsory imports? Compulsory imports include things like crude oil, activated pharmaceutical ingredients. You cannot do away with them. So you have to buy them. So what will happen? Your import bill is going to increase. When your import bill increases, your balance of payment situation is going to worsen, right? Because imports bills will be high, right? So that is why RBI cannot let this happen beyond a certain limit. So RBI has to jump back in the market with its open market operations, and what it has to do? It has to put dollars in the market. What will happen if RBI puts dollars in the market? When RBI puts dollars in the market, there will be more dollars in the market, and hence the value of dollar will go down, and $1 will again become somewhere close to 83.5 rupees. I hope you understood this. So this is what the RBI would be required to do, and this is what the RBI did. And to do this, to put dollar in the market, what will RBI do? Take it from its own fund. That is why from $705 billion, we went back to close to 650, but again that is further increasing. Now, what are the sources of foreign exchange reserve movement? Sources of movement means the reason for the movement of the foreign exchange reserve. See, this foreign exchange reserve means how much a country has, whether it has a surplus or a deficit, depends on two major things. One is the current account and the capital account. Current account and the capital account. So foreign exchange can be in the current account and the capital account. The current account will have incomings and outgoings. Capital account will also have incoming and outgoings. Now, let us understand why the free fall is unlikely. The free fall is unlikely because the current account deficit. So foreign exchange is made up of current account as well as capital account. Now the current account can have a surplus or a deficit, whereas the capital account also can have a surplus or a deficit. Now if there is deficit in both, the entire foreign exchange will be in negative, and we will have to pay from our own pockets or the Reserve Bank of India, right? So this is the situation. But why the free fall is unlikely is because the current account deficit, that is called as the CAD, it had previously climbed to around $88 billion in 2012-13. Meaning we were in a deficit of $88 billion in 2012-13. Now we have reduced it so much that now the current account deficit is just $23.29 billion. Not just that, many a times it has been positive also. This is what? This is the amount of deficit we are having. But many times there have been years like, for example, 2020-21. When the current account deficit was positive. It was positive means it was not a deficit, it was a surplus. So current account deficit is the deficit which is, you can say current account is the one which is helping us because it has turned surplus also, or if there is any deficit, it is very less, and at times it turns surplus also. So if this is surplus, it is going to absorb a lot of, or let's say at least some amount of, it is going to absorb some amount of the deficit of the capital account as well. I hope this is absolutely clear. Further, we have a robust and structurally surplus invisibles account. What is invisibles? Invisible account means the account with respect to the services. Why it is called as invisibles? Because you cannot touch, feel or see the services. Services are intangible, invisible, it cannot be seen, as a result of which, the current account will have two components. One will be the goods, commodities, that is trade, and other will be the services. Now this services is known as the invisibles, the goods are known as the visibles. So now this current account is very healthy is what we are saying. It is not healthy with respect to the goods, it is healthy with respect to the services where we are having huge amount of surplus. And since it is healthy with respect to services, it is addressing the issue we may be facing with respect to the goods trade over the world, right? So everything seems good. Then why are we fearing it so much? We are fearing it so much because whatever good we have seen so far is with respect to the current account. but there are still concerns with respect to the capital account. There is no issue with respect to current account. This is all good. The issue is with respect to the capital account is what we will see. So what does the capital account consist of? A capital account consists of foreign investments and as well as your remittances. So it has foreign direct investment. Foreign investments means foreign direct investments plus foreign indirect investment, that is foreign portfolio investments, plus you have external commercial borrowings and the remittances or the account that the non-resident Indians, NRIs, will hold. This consists not the remittances but the non-resident deposits which will be of investment or fixed nature will be a part of the capital account. Now these are the part of capital account. Now out of this only the FDI is very stable. Only the FDI flow is stable because they are there for a long period of time. They are there for a long period of time. As far as other sources are concerned, other sources as in FPI, NRI account or the external commercial borrowing, these are very fickle. Fickle means frequently fluctuating, changing, at the same time very short term. For example, external commercial borrowings, the banks can anytime demand the loan to be returned. What will you do? You can't do anything about that. Plus they are short term also. So these faces issue, we cannot be much sure about it. So it is the capital account which can create a problem. So our current account is doing good, capital account may have an issue. So ultimately it boils down to the net impact based on which we are going to predict what is going to happen. Now when we talk about the situation of a free fall of the Indian rupee, it is highly unlikely. Something like that had happened in 2011-12, so it is easier for us to compare the situation with 2011-12 and realize the present situation is actually better, hence it will not happen. Why? Because the capital account may be pushing or pressurizing, but the pressure it is creating now is way different than the pressure it created in 2011-12 and 12-13. Now how is it different? Let us understand that. In 11-12, India was having large current account deficit. So capital account is an issue, plus large current account deficits was causing the problem. So what was happening? Negative and negative was giving rise to a small negative, plus small negative was giving huge rise to a big negative. What a small negative? In fact this is a large negative. Current account was a large negative and this was also a large negative. So it was actually giving rise to a larger negative. But presently what is the situation with respect to current account deficit? It is either very small negative or at times it is small positive also, right? So it is not creating this kind of a situation presently. It is not as high, plus at times it is positive also, as a result of which even if it is, let's say, negative at times, so Reserve Bank of India has a lot of foreign exchange reserve so as to address that CAT situation, and at times it becomes positive as well. Plus in 2011-12 there was US Federal Reserve which was basically tapering means unwinding the bond purchases program. It had started a bond purchase program through which it was purchasing bonds, but then it stopped that. Since it stopped that, what happened? The dollar became stronger at that time. Now that situation is again not present. Since that situation is also not present, this again would not be an impact. The only impact that remains is due to the capital account. Now to address this issue of capital account, which is in a manageable limit, so not a problem, but to further address this, what we can do is try to attract more amount of FDIs, because FDIs are the most stable form of foreign exchange reserve when it comes to the capital account. Clear? So no matter, some corners of the economists may talk about the free fall, but the free fall is not going to happen. We have a huge amount of buffer, plus we have now close to $658 billion to play with, as a result of which, and also every week $1.51 billion of increase is also happening in our foreign exchange reserve. So all this points towards a sort of stable dollar and rupee relation. There might be slight increase in the value of dollars, fine, but not a free fall of the rupee in its value terms. Alright, so thank you so much. Stay tuned for more such videos at Legacy IAS Academy. Thank you.